Monetary policy and fiscal policy are two distinct tools used by governments and central banks to manage and stabilize the economy. While they both aim to influence economic activity, they operate in different ways and have different objectives. In this video, we will define what monetary policy and fiscal policy are, the objectives of each type of policy, as well as the difference between the two policies. So, without wasting any more time, let us get into today's video. Let's start by defining what we mean by monetary policy. A monetary policy is one of the tools used by the central banks of each country to manage the money supply in order to achieve their goals. At the macroeconomic level, a monetary policy is used to achieve a country's macroeconomic objectives, like a specific level of inflation, increased consumption and growth, as well as the country's liquidity. This is usually achieved by employing strategies such as setting and revising interest rates. We will now define fiscal policy. Fiscal policy is a form of government policy that uses instruments such as taxation, public spending, and public borrowing to achieve various economic policy goals. Essentially, a fiscal policy is when governments use public spending and tax policies to influence economic conditions, especially macroeconomic conditions. These conditions may include a demand for goods and services, employment and unemployment, inflation, and the overall economic growth. We will now discuss the objectives of each of these policies. The primary objective of a monetary policy is to achieve price stability and control inflation. Central banks adjust interest rates and manage the supply of money to influence borrowing costs, investments, consumption, and the overall economic growth. Fiscal policy, on the other hand, aims to achieve broader economic goals, such as promoting economic growth, reducing unemployment, and maintaining price stability. Governments use fiscal policy tools to influence aggregate demand, income distribution, and the overall level of economic activity. Fiscal policy and monetary policy are often contrasted with each other. In the next section, we will look at how these two concepts differ. But before we get to that, let us say, welcome back to our channel, proudly brought to you by Kano Consultants. For professional advice you can trust. Now, back to today's video. So, what is the difference between monetary policy and fiscal policy? As previously indicated, the primary concern of monetary policy is the management of interest rates and the total supply of money in circulation. Central banks use monetary policy to stimulate or manage the growth of an economy. This is predominantly done using tools such as interest rate increases or reductions, as well as increasing or decreasing the supply of money in circulation. Fiscal policy, on the other hand, rely on taxes and government spending to impact demand in an economy. If, for example, a government believes that there is not enough business activity in the economy, then it can either increase government spending to stimulate the economy, or reduce taxes in order to stimulate economic activity. Fiscal policy is also under the authority of the executive of the government. This means that it is controlled by governmental institutions such as the presidency, as well as legislative branches of the government, such as Congress or Parliament. While monetary policy, on the other hand, is the responsibility of a country's central bank, such as the Federal Reserve or the Reserve Bank. Most countries strive to keep the role and functions of the central bank independent from government interference. Monetary policy has a less direct impact on the real economy. It is mainly used to manage the supply of money in a country's economy. With monetary policy, a central bank increases or decreases the amount of currency and credit in circulation in a continued effort to keep inflation growth and employment on target. Governments, on the other hand, can use fiscal policy to influence the economy. either through changing the level and types of taxes, the extent and composition of spending, or through the degree and method of borrowing. In terms of risks for each of the policies, a weak or loose monetary policy can increase money supply excessively and has the potential to cause inflation. Fiscal policy, on the other hand, can be swayed by politics and the loud voices of voters, which can lead to poor decisions that are not informed by data or even economic theory. Before we continue, we are excited to announce our sister channel, Kano Academy, so please subscribe to our Kano Academy YouTube channel and leave us a comment suggesting which educational topic we should cover. And remember to show your support by pressing that like button and sharing our videos on your social media. In conclusion, there is much debate on whether monetary policy or fiscal policy is a better tool for economic growth. We do not intend to get into that debate on this video. However, we can only highlight that both monetary policy and fiscal policy have pros and cons that should be considered. So, just to recap, the basic aim of a monetary policy is to determine how much money an economy should have in circulation. Monetary policies of each country may differ, but most major economies aim for low and stable inflation. And these countries will usually announce their inflation targets publicly. Fiscal policy, on the other hand, is the mechanisms or tool used by governments to manage their tax collections and public spending in order to influence the economy. Governments typically use fiscal policy to promote strong and sustainable growth and reduce poverty. The objectives of a fiscal policy recently gained prominence during the recent global economic crisis, when governments stepped in to support financial systems, jumpstart growth, and mitigate the impact of the crisis on vulnerable groups. We've come to the end of this video on the comparison between monetary policy and fiscal policy. So, thank you for watching. Please take time to check out our other videos on public administration and public finance under this channel, where we discuss various topics relating to public administration, public finance, public management, as well as the management of the public sector, including the running of government. And don't forget to like this video and subscribe to our channel for more content. And remember to turn on the notification button on your phone to make sure that you don't miss out when we post new videos. You can also connect with us by following us on social media at ConsultKano, and continue the conversation by leaving us a comment or tagging us on social media using the hashtag ConsultKano. Thank you again for watching. Join us again next time for another video. Until then, check out these other videos. Kano Consultants. For professional advice you can trust.